Today I'm going to talk about mortgage protection as it's commonly miscalculated and misperceived. So what mortgage protection is simply is a life stroke debt policy. It's generally you can use a decreasing term policy, and what this means is that the life cover would go down every year in line with the mortgage. This makes it nice and cheap. The premiums for these are usually fixed and don't change. With a mortgage protection policy, I suppose the idea behind them is keep them as cheap as possible because the bank usually have the ownership of them, not you. So why give away something really good when the bank have the ownership? You can get these in single life form or dual life form. There is also a joint life form. So to explain them, single life, obviously just one person covered. Dual life, both people are covered and the policy will pay out on both debts. Joint life, the policy only pays out on the first debt and then the policy ends also. There's lots of companies now doing dual life for the same price as joint life, so that is the way to go. It just gives you that extra bit of cover for nothing, for no price at all. If you're taking out your mortgage protection with the bank, don't. Banks in this country, you have basically two insurance companies tied to banks. So you have Irish Life, who are tied to most banks, and then you have New Ireland, who are tied to Bank of Ireland. In most cases, these prices that they give can be completely and utterly beaten by brokers. So well worth shopping around with a broker, or better again, come to us. Also, when you're taking out a mortgage protection policy, you're better off if you can to keep the serious illness cover out of it, because if you get God forbid a serious illness, then that money will go straight to the bank, leaving you nothing to play around with. Whereas if you do that separately, you have that in your top drawer, as I say, and if something happens to you, at least you have time and a bit of financial help behind you to recover and so on. So that's basically mortgage protection. Just to give a quick recap again, joint life pays out on the first debt, dual life pays out on both debts, and single life obviously is just a single life policy. Decreasing term means that the cover, as in the debt benefit, goes down every year in line with a mortgage, so this makes them nice and cheap and cheerful. Again, always the way to go when you're getting a mortgage from the bank, because why pay huge money for something? Also, you can now get these in convertible form, which means that it would be decreasing, but at any stage you can change it to a level term policy. Not many people go for this option, but it is handy if you're thinking of borrowing down the road further again. It can be worthwhile maybe looking at that. It's only a few quid extra. If you have any health conditions at all, always apply early, because you don't want your mortgage being held up. So it's well worth maybe going in a month or two in advance, having your mortgage protection set up, and just leave it sit there until you need it. But it's well worth doing that, because the last thing you want is you're ready to draw down a mortgage and all of a sudden, no, we delay in the life cover. You don't need that situation. So that's basically it. That's what mortgage protection is in a nutshell. If you want to know more, please come to us. We'll explain more to you, and have a good day. Thank you very much.